Well, great. Hello, everyone. This is Rob Fleetwood from Ferrazzano. I want to welcome everyone to today's webinar hosted by the law firm of Ferrazzano, RSM, an accounting and consulting firm, as well as Piper Sandler, a financial advisor in the banking industry. So really looking forward to today's presentation. This is a follow-up or a continuation, probably for a better description, from what we did back in May. I think probably the only thing consistent from our May seminar is PPP is still on the menu, although we promise we're not going to go into the level of PPP that maybe we did back in May, but there are some important things to chat about on that, as well as the fact that your presenters, some of which you can see on your screen, and we'll go through the list of them in a moment, are all still working from home. So many of us are in Chicago. Brandon from RSM is up in Minneapolis. But I think kind of a walk away from that is, and I know from looking over the attendance sheet, we've got a lot of people from different geographies and from different urban environments. So some of you may have been back at work or never left work on a day-to-day basis. People in Chicago are starting to go back, but there's still, I think, more empty chairs on Metro than full chairs. And for the most part, people are being pretty selective on when they're going back to the office to the extent they have that choice. But what we want to do, I'm just going to do a real quick intro, and then I'll turn it over to some other folks to introduce themselves. But the premise of this really started 12 years ago or so during the first big financial crisis, where we teamed up with RSM. I think back then they were known as McLadry. Maybe even that was 2 or 3 iterations ago of their name. But we teamed up with RSM and did a series of webinars walking people through what we were seeing during that crisis. And we turned that, once we turned the corner on that, we turned that into an annual conference. Sometimes we did it twice a year, but we always did it at least once a year in the Chicago area, and invited many of you, and I know many of you attended. And as we came into the current crisis with COVID and the shutdown and the economic turmoil with it, we thought it'd be a good idea to go back. Obviously, can't get a whole group of people together, and we couldn't do our seminar, but we thought we'd do the next best thing, which is get people on a Zoom or a similar software and just talk about things and share ideas about what we're seeing. We look at it from lessons that we learned 12 and 13 years ago, as well as what we are hearing from all of ours, Barrick, RSM, and Piper Sandler's, all of our diverse client bases. And we hear a lot of different things from banks that are 200 million in size to 25 billion in size, and what they're battling with right now, what they're concerned about. And those are the types of things that we want to make sure that we're able to share with you guys today. So we're going to hit a couple different big topic areas. We're going to talk about the lending programs. Again, we won't go into as much of the granularity with PPP as in the past. There are some new tax considerations that RSM is going to hit on that relate to the PPP programs and the forgiveness around those. John Friechek and I will talk a little bit about what we're seeing with second quarter earnings so far, both just from anecdotally from conversations, as well as what we're seeing the big banks releasing this week. Talk a little bit about capital and M&A, and then we'll switch it over to a mini Behringer report of kind of ongoing regulatory issues from enforcement to examination, safety and soundness, and the like. So that really kind of the basics for what we're going to do. Kind of real quick before I turn it over, for those of you who don't know us, and I think a lot of you from looking at the list have attended this before, or we've been on a deal with you in one way or the other. I'm with Ferrazzano. I'm co-chair of the Financial Institutions Group. We have a very large financial institutions practice, 25, 30 attorneys that work, almost exclusively with financial institutions. So we see a lot, and we see the small banks and we see the big banks. I do corporate stuff, so I'm going to handle the M&A and the capital slides with John Friechek from Piper Sandler. My colleagues, John Geiringer is head of our regulatory group. He used to be a regulator with the state way back when, and he heads up our 5 or 6 regulatory attorneys, and he's going to be talking with John Behringer about the regulatory aspects and what they're seeing from all the regulatory agencies right now. We also have Lynne Mapes-Riordan, who chairs our executive comp and employee benefits practice. And she's going to talk about some of the issues that we're seeing with employees, closing down branches, reopening branches, whether or not you need to close them back down if there's the quote unquote second wave. And then we also have Stan Orzula, who's a partner at our office who does a whole wide range of things, including loan workouts, and he's been busy right now on that, loan modifications. He was our point person on the PPP details, and we'll be talking with Brandon about that. And he also is actively involved in many of the fintech relationships that our banks are entering into. So he's going to touch on that. Before I turn it over to John Behringer, maybe real quick, John Friechek from Piper Sandler. John, give a few words about Piper and yourself for the group, please.
Yeah, thanks, Rob, and appreciate the chance to participate here, and thank you for everybody for dialing in. John Friechek, Managing Director with Piper Sandler in the financial group, focused on the community bank space. And as Rob alluded to earlier, I'll kind of give the investment banker perspective, really focusing in on what we're seeing in Q2 earnings, capital markets, a little bit in terms of green shoots of M&A poking through the ground right now, and kind of walk through those areas. And John Behringer, I'll hand it over to you to introduce the RSM team.
Thanks, John, and want to thank you all again for attending and joining us today, and thank our friends at Ferrazzano for a very strong and vibrant partnership between their colleagues and our colleagues at RSM. As Rob alluded to, RSM is the 5th largest public accounting and consulting firm based in the United States, and we're really focused on the middle market. And as part of that, having a very vibrant banking practice is critical. And we work with about 1,200 institutions on an annual basis across the U.S. I'm a partner in our risk consulting practice and have the distinct pleasure of leading our financial institutions practice here in the Great Lakes, and also leading our consulting practice nationally for the financial institution sector. Joining me today is Brandon Koeser. Brandon's a senior analyst in our Eminence program. So focus is really on key economic and industry issues impacting the capital markets, and in particular, the financial institution sector. And if that wasn't enough, he's also, his day job is as a senior manager in our audit practice. So I'm going to hand it over to Brandon and Stan in a minute here to start on PPP. But before I do that, I just want to remind everyone, at the bottom of your screen, you should see a Q&A box. Please feel free to enter questions throughout the presentation. Those of you who joined us last time know we kind of monitored that, and we're able to ask questions to the panelists real time, so please feel free to use that. I know we received a few questions in advance yesterday, and so our plan today is to have the speakers address those questions during their presentation, but certainly use that. Also, if you have any technical issues or questions, there's professionals from Barrick monitoring the chat box. Please use that for any of those questions. And with that, I'll give it to Brandon and Stan to kick us off. Thanks, guys.
Thank you, John. As Rob alluded to, we're going to start the program here talking about some government lending updates. And I was a little worried last night, admittedly, that there was going to be a release from the SBA coming at like 8 or 9 o'clock that would change the whole format of this presentation. But fortunately enough, or maybe unfortunately enough, there wasn't the update. So we're going to kind of move through at least the next couple of slides relatively quickly, just to touch on some high points. And obviously, we'll start here real quick, just reminding everyone that the PPP was extended through August 8th, and there is still money left available. From talking to some institutions around the upper Midwest and the Southeast, they've started to see customers come back that wanted to get those funds that may have not tapped into it right away. So there still is some demand for that. But one big reminder I wanted to bring up, just because I've started to hear some of this starting to happen, and that is the SBA beginning to pull loan applications for review. Now, the SBA did, when they had the safe harbor provision passed, indicate that loans under that $2 million threshold were going to be safe harbored, where they wouldn't necessarily be subject to review. It would just be assumed that you met the application criteria. But those loans that obviously would be subject to review. And now, as things have kind of passed through the big wave or rush right away, the SBA is kind of starting to circle back. And the applications that I have heard of being pulled so far are only above 2 million. But something to be aware of, because as we begin to move in the forgiveness phase, the SBA has said that the lenders, once a loan has been pulled for review, cannot actually submit the application for forgiveness until that's completed. So obviously that can add some wrinkles into things, as I know many of you on the webcast today, specifically on the borrowing side, are hearing from your borrowers, and they're asking, when can we start submitting our applications, especially if they follow the original 8-week criteria. A couple other things to bring up. One, here the AICPA did issue some technical questions and answers related to accounting guidance for items relating to the Paycheck Protection Program, not only from the lender side, but also from the borrower side. Important things to know. I know, just from talking to my auditing clients, that they asked a lot of these questions back in June, right around the time this was issued. If you aren't aware, though, I would still encourage you to go check out that. There's plenty of great information in there. And then I think, next up, we want to turn it over to Stan to talk about another important thing related to the agent fees.
Sure. Thank you. Thank you very much, Brandon. And the last time we had this presentation, we did discuss the fact that there have been several lawsuits filed over agent fees. As you may recall, PPP allows for agents to receive up to a certain percentage, capping out between 1% and 0.25% of a loan based on various activities like arranging a loan and other matters, and bringing the lender and the borrower together. However, unfortunately, the rules weren't clear as to who that actually applies to and what steps need to be taken to obtain an agent fee. And as you all know, the PPP program follows in certain ways some other aspects of this 7A and other SBA government lending programs. And under those programs, usually if an agent fee is to be paid, there has to be privity of contract between the agent and the bank and the lender. And what's happening is that the agents are suing, trying to obtain the fee. However, there's a question if the agent doesn't have a contract with the lender, whether they're able to pay it. Well, since we've spoken last, the Secretary of Treasury has come out and has said that approximately 2 to 3 weeks ago, that there would be greater clarity on the agent fees, and suggested that there has to be a contract between the lender and the agent. So hopefully this will give banks a little more clarity when the guidance comes out, and it will be favorable to the banks. And hopefully this will perhaps extinguish some of the agent fee lawsuits that are out there. The next issue is publicity. As you may have seen recently, one of the large banks agreed to donate the $400 million in PPP fees that it had received through the PPP program to support small businesses. And this is an interesting issue because there's a lot of publicity. Even though PPP is not that profitable program, there is some societal and pressure out there for either for banks to otherwise contribute by giving up their fees. But it'll be interesting to see what happens with that. And also, along with the $2 million review question, the SBA also published the names of all PPP borrowers that received $150,000 and above. And that information is available by looking up on the SBA's website. So probably we can expect to see some journalists looking into that information and drawing some conclusions about the PPP program. And then finally, loan sales. We've also seen certain non-bank lenders out there purchasing PPP loans at close to par or at a slight discount. And the advantage to a bank that's interested in doing this is that they don't have to go through the forgiveness process, because it will be serviced by the non-bank lender that's purchasing the loans. So again, it'll be interesting to see how many loan sales are accomplished and how many banks decide to go ahead with the forgiveness process. So that's it for PPP. But as you know, what we say today could totally change tomorrow. And I too was dreading any last minute changes to the PPP program before this presentation as well.
Thank you, Stan. Speaking of changes, let's move on to the next slide here and talk about the next up for government programs. Obviously, I think everyone on the webcast today is familiar that the Main Street Lending Program is fully operational. I don't want to spend much time talking about any of the relevant terms other than just based off of commentary that we've been following from the Fed, as well as those trade groups and financial institutions that are analyzing whether or not to participate in the program. Additional changes are highly likely. A couple of the indicators that we are analyzing just based off of what we're hearing from our policy team in Washington is a possible lowering of the minimum loan size. Right now it's set at $250,000 for the main new loan facility and the priority loan facility. That could further decline to allow additional businesses the opportunity to participate, and there's also discussion that the rates could change. So if you've been talking to borrowers, you've been analyzing as an institution whether or not we should participate, obviously stay tuned, as more will likely come out of that. But also a big thing that I'm going to turn over to Stan to talk about is the important lender consideration.
Sure. Thank you very much, Brandon. Main Street Lending was initially described as a supersized PPP program, but it's actually really a different creature. And the challenge for lenders are loan documentation challenges, reporting challenges under the program. There's a lot of reporting that's required. And the issue is some of the Main Street loans under, in fact, 2 to 3 programs, the minimums are pretty low. So it's a lot of work for smaller loans. And then there's also 2 interesting issues that have come up recently. One is we've heard from a bank's accounting firm that because up to 95% of the loan will be sold to a Fed special purpose vehicle, is that a bank may have to have a true sale opinion. And the question is, if they have to do that for each and every Main Street loan, that just completely blows out the economics of the program for the banks. So, and we don't know if it's required, but it is one consideration for a bank to look at if they're considering lending under the Main Street, the MSL program. And then the other issue is if a bank has an existing borrower that wants to partake in the Main Street loan program, there's a question that whether if the borrower has a pre-existing loan with the lender, whether those liens are either primed or are shared, or payback is on a pari passu basis with the Fed SPV. So that's another consideration too, if you already have an existing loan with the borrower. And as we mentioned about how things are changing, actually on July 15th, the FAQ page for the Main Street Lending Program was updated with some clarifications and changes. So in case you haven't looked at it lately, that's out there as well. And then the last issue is LIBOR. These loans have a LIBOR rate, but as we all know, LIBOR is going away shortly. So the challenge is what does that replacement rate look like, and how will that affect the Main Street loan program if the loans go through the full maturity?
So obviously a lot of things to be mindful of, and as Stan alluded to, there's been changes, there are going to continue to be changes. So more to come, as I think all of us are aware, just given the nature of these programs. The last section we just kind of run through here is some of the updates coming out of Washington. And really, the first two items that we have here, the HEROES Act, which was a House resolution passed back in June to provide roughly $3 trillion in aid to various individuals and parties, which included additional assistance for small business in the form of grants. That is something that is now going to be moving over to the Senate. Obviously, if it was passed with a very partisan flair in the House, one would say that it might stand a little bit of a battle in the Senate, but obviously something to be mindful of, as well as the Restaurants Act, which is something that has complementary bills both in the House and in the Senate. And this would establish some assistance specifically targeted for food services, restaurants, as well as some drinking establishments. Both HEROES Act and Restaurants Act, just important to be mindful of because they include provisions in there that would have more of a grant feel, similar to the Paycheck Protection Program that I would envision. Financial institutions, again, being tasked with assisting and providing that aid to small businesses. And then the last item here, which I think is something that a lot of bankers are following very closely, and that's the Paycheck Protection Small Business Forgiveness Act, which would in reality provide automatic forgiveness for these paycheck protection loans that are under $150,000. It has a lot of support from trade groups, both in business and in banking. I think the last count that I saw, it was nearing 160 individual organizations had sent letters into various members of Congress advocating for the passage of that. I would say from a lender standpoint, given that roughly 80-ish% of the loans originated through the Paycheck Protection Program were under $150,000, this would no doubt be a big lift in the burden of processing loan forgiveness. Stan, I don't know if you have any thoughts given how you follow the Paycheck Protection Program, if you feel this is something that has a chance. Obviously, I think it seems to me that it pulls at the right heartstrings that may get at some relief for not only businesses, but also bankers, but obviously something to follow once we get into the session that'll start up next week.
Well, absolutely. And also remember too, that it's an election year and something like this is probably well received more in election year than any other time. And also I believe one of our participants today actually had this same question. So I think it's definitely more likely than not. And if it's enacted, it will, like you said, relieve a huge burden, both on not only just borrowers, but also on banks as well. Because one of the challenges with the PPP is that a lot of the guidance says that a bank can rely on a borrower, but it's a trust and verify. And we just don't know how much a bank will have to verify and what they have to verify may change from day to day. But this, I think, would definitely alleviate a lot of burden on banks if it's passed, and we think it will be.
Absolutely. So obviously, as Congress heads back to Washington next week, something to pay close attention to. I think with that, we are through kind of the first phase of government programs. We're going to turn it over now to John Behringer to talk taxes.
Thanks, Brandon. And you don't know how I shudder when I hear John Behringer and talking taxes. So I apologize to all of you in the audience. I am pitch hitting for the very venerable Mr. Frank O'Connor. So give me a good report card and go easy on the questions if you would. But in all seriousness, just a couple of things I want to make sure we touched on, backtracking a little bit here to the PPP program. So really two key kind of unresolved questions have come up. And I guess those of you tracking the unresolved PPP questions, I should say related to tax, to narrow the field there. But the first one is really in response to some dated but still applicable existing federal tax law around just the ultimate characterization of the fees that lenders have been paid. And that is, given that there's an explicit government guarantee, is this underlying transaction a loan or really just a service provided on behalf of the SBA by the lender? And that plays into not only a timing question on revenue, as Brandon alluded to. While we've gotten pretty good guidance on the book side, we always have to consider tax. And then the second piece, there is a multi-state issue, as a lot of these loans for those of you, and we know a lot of banks have national SBA or lending platforms, you may have originated loans to borrowers that aren't necessarily located in your home state. So that characterization will impact how you allocate that revenue as well, and not only the timing. The second piece of the question is, do the banks or lenders need to perform Form 1099-C reporting for the debt forgiveness? We know typically if you forgive any debt more than $600, that's going to trigger a reporting requirement. However, given their specific language between the lender and the borrower that acknowledges a portion or in fact all of the amount may be subject to forgiveness, given the nature of the program, that may exclude it. But the devil is always in the details, in that for the portion of these transactions where the full amount isn't forgiven, you end up with a loan amount, and then down the road we have a default, you could potentially trigger a 1099 situation then, because we've moved out of the original transaction into a loan, which will be documented again. So the good news is industry groups have been engaged in some ongoing dialogue with Treasury and the IRS, and hopefully we'll have some more concrete guidance around these. But in lieu of that, if we can go to the next slide, we've got a couple of thoughts on what lenders should be doing as we wait for kind of final review here. So with that, the first one is go ahead and work with your accountant and look at your current tax method for treatment of loan fees. Understand that and understand how that could potentially change if this is characterized as fee income as opposed to a loan, particularly for those transactions where we've got full forgiveness when the borrower applies. Second, make sure we're tracking by state the loans we've originated along with the fees we've received by those loans by state. And then last, as you're thinking about the forgiveness process now, making sure you've got a program or a process in there to monitor and report any default on those unforgiven loan amounts, and make a note that you may need to consider 1099 reporting for that subsequent default. So with that, I am done talking taxes. I can quit shuddering here, and I'm going to turn it over to Rob and to John Friechek to talk through something I'm sure we're all interested in, which is second quarter results and M&A. So go ahead, gentlemen.
And Rob, you're on mute there, so I'll kind of kick it off here. Thank you, John. To touch a little bit on what we're seeing this week from the largest institutions, the headline, of course, has been credit. And, as expected, it's been the headline for a good reason. Some of the larger banks spooked the market a little bit when they gave guidance a few months ago that they were expecting to see Q2 reserve builds at or exceeding the levels of Q1. Now, what we've all been waiting to see is what exactly that meant in terms of magnitude, and now we're starting to get a sense for that. And to give you a couple of examples that you might have already seen over the past couple of days here, Wells Fargo announced a provision expense this quarter of $9.5 billion. And to put that into perspective, a year ago, they had a provision expense of $500 million for the quarter. That jumped up to $4 billion in Q1, and now that more than doubled in Q2 to $9.5 billion. Now, not all of them have more than doubled their reserve build from Q1, but even for the ones that haven't, we've still seen a lot of credit misses where more along the lines of, for example, a US bank that provisioned $1 billion in Q1, that's jumped up to $1.75 billion in Q2. And so despite the fact that you've seen some strong capital markets revenue, trading income, helping to keep Q1 earnings more respectable, the big ticket item has just been the reserve build and the provision expense you've seen from these larger institutions. And that's, of course, the topic du jour for our community bank clients as well, where how do you grapple with this topic right now when we still have so much uncertainty? And that's an issue we hear from a lot of our clients where they look at their portfolio and their chief credit officer tells them that, the good news is that based on what we're seeing right now, it's difficult to justify stashing a large amount into the rainy day fund. But by the same token, we know that there is this uncertainty in the third and fourth quarter when some of these government programs run out, what might the COVID environment look like going forward? And it's really a challenge for a lot of our clients right now. And that, that really is the same for, we have a bullet here for goodwill impairment. And it's a similar situation where you saw a handful of goodwill impairments in the first quarter. You're going to see some more here in the second quarter. But again, for a lot of banks in mid-June, it looked like goodwill impairment wasn't going to be an issue after the market rallied. And then all of a sudden, we have a couple of very volatile trading days towards the end of the month, and goodwill impairment is suddenly back on the table. And so these are some challenging issues that we're seeing a lot of our banks still grappling with. But the bottom line is that you are seeing this reserve build continue into the second quarter as banks try to cover for this uncertain credit environment heading into the second half of the year. And Rob, I'll let you touch on a few of the other bullets.
Yeah, and we've certainly seen that as well, and I've had conversations with that. I think I guess the walk-away good news is from an operating income point of view and just their core earnings. The good news walking away is they still seem pretty steady. So I think it really is coming down to ALL and what they're going to take. Touching on goodwill a little bit that John mentioned, we do have a number of clients who are now looking at that when, again, they didn't think they'd have to maybe a month or so ago. There's some timing issues around that due to the length of time it takes to get the consulting firm who's doing the analysis to come up with with their provision or with their analysis, and then having to get it through your auditors. So if you're testing, get it moving as quickly as you possibly can so that it doesn't hold up your earnings releases. The other thing to keep in mind, if you have a lot of goodwill and if it looks like you're going to take a big impairment, you have to factor into how that is going to impact your ability to issue dividends down the road, including this quarter. So we've had a client or two who were going to make dividend announcements before determining whether or not they're going to have a goodwill impairment. And that's tricky to do. Again, depends on the size and the likelihood of the magnitude of the goodwill write down. But keep that in mind. If you've got a goodwill issue, factor how that's going to impact your dividends, which we'll talk 094 in a little bit as well. A couple other walking away points is I think it's more important than ever that private companies are communicating with their shareholders maybe more than what they normally have. Many of our private banks don't communicate on a quarterly basis, but do kind of the annual checkup and State of the Union. I think it's a good idea, and we're talking to some folks about getting more information to them. I think there's one thing that no matter where we are in our careers or stages of life, at least for the people I'm talking to, more communication on uncertainty, the better. Whether it's if your kids are going back to school, whether it's your office is going to reopen, whether it's what have you. I think the same is for private investments where there's not a liquid market. It's important to keep people up to speed on what's going on. The advantage of that as well is in the event that you have shareholders who want to diversify or liquidate some of their shares, might be easier for them to do so if they're getting more current information. And it might be even to a point where you can consider as an institution repurchasing some of those shares from them. So that's something I think that the private banks need to think about pretty hard. The other thing we'll touch on real quick down at the bottom, the SEC put out on June 24th or 5th kind of an update piece on what they're expecting companies to disclose about COVID. Now, those primarily are going to be for the public companies. So for the publicly reporting companies, you should get your hands on that or talk to your legal or financial advisors about what's in that. Not that there's any great surprises on things, but you should tick through. It's a pretty easy read and make sure that you're covering some of those items that the SEC is expecting to see. For smaller kind of quasi-public companies or for the private companies who are going to increase their their communication with with their shareholders, you might want to look at that as well and just see if there's an easy thing to throw in there that your shareholders might be interested in. And if you need information on that, feel free to reach out to us and we can get you a copy of that. Moving on to the next slide, we'll talk capital a little bit. I think probably everyone is aware in the industry that there's been a flurry of sub-debt and preferred stock activity since mid-May. Our firm has been involved in 18 different offerings, and we were able to divvy up different teams. So we had 3 or 4 different teams handling all of those to get through those as efficiently and quickly as we could, and I think it worked out well. I know John and Piper Sandler have been on a ton of deals over the past couple months. John, turn it to you for a minute, and maybe Michelle. We have as an appendix here, I know you guys can't freely go through the deck, but this will be available after the presentation. John was nice enough to put together kind of a list of all those sub-debt and preferred stock deals that have occurred since May, both public and non-public deals, or the larger non-public deals. John, any notes or any kind of highlights? Rates seem to be between 5 and 6 something, a few in the 7s. Any words of wisdom here?
Absolutely, Rob, and you're absolutely right. We have, and as you alluded to, we've been book runner on over half of the bank sub-debt deals that have taken place this year, and it is a very active market. You touched on preferred as well, and I'll touch on that briefly, where you have seen a few transactions. For example, one on the list there is Ocean First, a $10 billion bank out in New Jersey, where Piper Sandler led a $125 million sub-debt offering for Ocean First at 5 1/4, and Ocean First then followed that up a few weeks later with a non-cumulative perpetual preferred offering of $55 million at 7%. And so you are seeing a few, in particular the larger banks, kind of topping off their sub-debt raises with preferred, but for the most part, the bulk of the activity is in the community bank sub-debt space. And as Rob just touched on a moment ago, this is public banks, privately held institutions. We're in the market with a $5 billion NASDAQ listed bank, as well as $500 million privately held banks. And so there is a market across the board right now for community bank subordinated debt. And we expect to see that continue here, in particular, once we get through Q2 earnings season a bit. We have a backlog right now where there is going to be a significant amount of activity as banks continue to look to tap into this market, which, recall, closed in the month of April when COVID was first really hitting in late March, really throughout the whole month of April, and opened back up in early to mid-May. And you're going to continue to see banks tap into this while this is open for them. Again, not knowing what credit might hold later in the 3rd and 4th quarter, as we touched upon earlier. And again, one thing to consider here is if you do want to move quickly, it is helpful, especially for larger issuances, to have a rating. And Kroll has become a dominant player for the community bank space. You also have Egan-Jones, where it takes some time to go out and get that rating and then launch your offering. And so one thing that some of our clients have done is that they go out, spend the time to get the Kroll or Egan-Jones rating, and then they're better prepared to move whenever the market dictates that it's the right time for them to launch their offering. And so that way you don't have to wait for 2, 3, 4 weeks to get that rating process completed. You're ready to roll whenever the time is right. And Rob, I'll let you touch on a couple of the last points there on the capital markets.
Thanks, and I can't emphasize enough on the Kroll rating. We had 2 clients that got derailed for a month because they didn't have a rating. And everything John just said applies to smaller companies as well. Unless you're doing a around the board table or a strict friends and family offering, you really need to talk to your financial advisor early on whether or not, even though you're not a publicly traded bank, whether it makes sense to get a Kroll or a Egan-Jones rating. And all companies, you know, we've got important to position company to take advantage of possible need. That's every single bank holding company that's out there right now. Keep track of your capital, keep track of where you can raise more capital, and put yourself in a position where if the third or fourth quarter gets demonstratively worse, that you're able to at least pull the plan off as best you can. The other thing to keep in mind, and you've heard us talk about 094, this is the supervisory letter that came out during the last crisis. When you're declaring dividends or doing stock repurchases, and stock repurchases I think are generally frowned upon right now, particularly larger publicly traded banks aren't doing them. Smaller, we've had a number of smaller private companies, as I alluded to earlier, kind of talking to shareholders about whether or not they can be a source of liquidity. If you're doing dividends, if you're doing stock repurchases, document your review and the input from management to the board about the factors in 094 and build it in your minutes. And depending on the magnitude of the dividend or the magnitude of the repurchase, what happens to your capital, there may be instances where you're going to want to visit with the Fed beforehand. So don't forget 0904 and keep it as a documentation issue in your notes and in your minutes so that regulators can see that you're paying attention to it. Moving on to M&A, and I think we can do this pretty quickly and then kick it over to the Geiringer folks. You know, very quiet is up in that first bullet. I think that's playing it kind. You know, there have been some discussions. There have been some of these unique deals that you see us listed here. But by and large, you know, what I used to spend 80% of my time on is no longer 80% of my time just on executing on M&A. So I heard someone say the other day, and I paused for a minute, and they're like, well, I think aggressively, if I took an aggressive position, maybe they open up at the end of September. And I thought, yeah, that's pretty aggressive. You know, who knows? I personally think, take it for what it's worth. I think people are going to wait till the annual kind of results are in for 2020, and that it's going to be a late first, early second quarter before we start getting meaningful deals moving forward. We are seeing some branch transactions and that. And before I misspoke, we're going to get Lynne in here next. John Freecheck, anything before we have Stan chime in on FinTech as well?
Yeah, just a couple of things there, Rob, and you're spot on. You know, we're seeing a few signs of life where there are a few deals happening, generally smaller transactions, though, involving maybe a credit union buy or a mutual holding company. But there was one transaction worth noting a few weeks ago where we were involved in a deal out in New York where there was a merger of equals between Bridge Bancorp and Dime Community Bank shares, $5 billion and a $6 billion bank merging in about a $500 million transaction. And just a few points there. One, as Rob touched on, you know, this is not a trend. This was the exception where, make no mistake, this deal was 8 months in the making. And you not only need to have a firm handle on your own credit portfolio, but for a transaction like this to transpire in this environment, these were two institutions that were very familiar with each other, very familiar with each other's loan portfolios, their credit cultures, and that allowed this to transpire. And so that, you know, is an important element here. And it's also interesting where virtually all of the due diligence since March, was virtual. The first time that the CEOs saw each other face to face since March was at the announcement in early July. And so, you know, sign of the times there. And the last important point is that Gateway Asset Management is the third-party loan review firm, assisted both parties in terms of their loan diligence here. And it's worth noting that on the seller's loan portfolio, they announced only a 2.1% gross loan mark, which you would look at and say, that's not out of line with what we saw pre-COVID. And so again, very interesting to see that, which, lower than expected, especially considering it seems like we can pretty much throw out a V-shaped recovery out the window at this point in time. That's an important piece of the equation here. And so, credit continues to rule the day for all of these transactions. And we're not going to see a wave of deals here anytime soon, to Rob's point. But there are some transactions where if you are comfortable with the counterparty, the cost savings are still there and can drive earnings in 2021 and 2022. And so we are continuing to see some dialogues, but those are going to be the exceptions, not the rule. And with that, I'll pass it over to Stan to talk a little bit about the fintech piece.
Thank you, John. What we're seeing, we represent a couple of banks that are more entrepreneurial in nature and are involved in fintech partnerships for doing bank of record and banking as a service relationships. And as we've seen those relationships evolve, we're now seeing that these banks are taken. They're also getting equity options in the fintech itself. And the reason behind that is that the banks are able to trade lower pricing on the bank as a service piece and bank of record piece in order to get the equity option. So if it is one out of 10 or 1 out of 100 fintechs that really evolves and the deal and the transaction flow flies up, they want to be a beneficiary of that gain. So I expect to see, more of that, especially since you have some fintechs that are, pretty small to begin with, and where having an expensive banking as a service agreement or bank record agreement prevents that fintech from obtaining outside investment.
Hey, Rob, before we go to Lynn, I'm going to just throw out, there was one question in the queue there, and Brandon, I'm going to put you on the spot first, and then certainly Rob or John Friedcheck, feel free to weigh in as well. One of our attendees was astute in noting that the money center, the national banks that have been announcing earnings and really taking significant reserves for potential loan losses had to adopt CECL, Brandon, as opposed to many of our community banks, which are still on the incurred loss method. Any insights yet on how much CECL is driving their reserves? And it may be too soon to tell, right? Maybe the answer is we wait and see earnings from some of the mid-sized regional and smaller banks that also as public companies had to adopt CECL, see where they land. But just curious, as you follow the markets, if you have any thoughts initially.
Yeah, well, my initial thought is obviously CECL is driving part of it. But to your point, John, we'll find out more when we get to some of the regional players that'll be issuing in a couple of weeks. There were 40 or 50 banks, public banks, that did not adopt CECL. So once those roll out, I think we'll be able to see a little more clearly what the difference is between the two models. I don't know if anyone else has other thoughts on that.
No, and I would agree with that take, Brandon, and I think it'll be interesting to watch how that evolves. So with that, Lynn, we'll hand it over to you to talk about reopening and potentially reclosing issues.
Thank you very much. And I'm going to do that from the perspective of an employer, not so much from any particular financial perspective. But what we're faced with is that some states are starting to reopen and some are having to look at reclosing or shutting down. And so there are special considerations that we have when we're trying to bring employees back. Now, banks, as essential businesses, certainly you had many of your employees still coming to the workplace, but many banks also furloughed a number of employees and had many employees working remotely when that was possible. So as you bring them more employees back to the workplace, you're going to have density issues. So please look at your environment. Do you have to revisit what physical barriers you put up? This is a branch by branch, location by location evaluation. And I suggest that you talk with your branch managers, your people on the ground there, because they know their unique space and they may be able to give you some insight into what they need to be able to keep distance. Another consideration that we have as we bring employees back is, did you communicate to employees if they were furloughed how it is that you would be bringing them back, what order, what criteria. And our circumstances changed now such that you would not be keeping with that plan? And do you need to communicate to employees what that new plan is? And again, I'll caution everyone not to make a determination on who to bring back at any given time based on perceived vulnerable employees or willingness to return, but focus on all those business needs, functions, location, etc. With that said, employees may be concerned about coming back, and if they have underlying conditions, you want to be as flexible with employees who identify their vulnerabilities and who may request an accommodation. Sometimes you're going to be obligated to engage in a conversation with the employee about an accommodation, maybe a return to working remotely. And that will certainly be the case if the employee has an underlying disability. With that said, it's true that prior to the pandemic, many employers were reluctant to provide teleworking or working remotely as an accommodation for a disability, under a belief that the employee could not be as productive, or maybe there were other challenges with that remote work. But now that we have much more experience, many organizations have much more experience with the remote working, that will inform the analysis on whether that's a reasonable accommodation in the future when an employee requests it. A quick note, if you return employees to work, or even if you have employees who are working now and you're looking at some pay cuts, be sure that you are looking at the salary threshold for your exempt employees, currently about $35,500, and don't inadvertently make them a non-exempt employee who has overtime eligibility. Quick note, some organizations are looking at improving on their screening when employees come into the workplace, and considering requiring a test that the employee is free of COVID. And the question is whether you would do that, and if that's prudent to do, if you have a reason to do it, and if you're going to do it and you're going to require it, check with your health insurance. Under the recent FFCRA and CARES Act, many plans are required to pay for that. Health insurance plans are required to pay for that testing. I'll note that there's some guidance under the Fair Labor Standards Act that for your overtime eligible employees, your non-exempts, the time they spend getting a test is likely compensable time. I'll note also, though, that the EEOC, while they said it's all right to require a test for whether someone has COVID to return to the workplace, it is not permitted to require an antibody test. And a uniquely seasonal question has been coming up, and I've been working with clients, and that is summer vacations and employees going to what are now hotspots for the virus, and concerns about them coming back and infecting the workplace, legitimate concerns. So we've been developing policies where employees are required, prior to going on their summer vacation, to inform the bank, inform the employer of where they're going, what they're doing. Basically, if it's a family reunion, much like on my husband's side, there's 150, 200 people there, that's a very large gathering, and you want to know that they were a part of a large gathering. That information can be used then to evaluate whether you'll require the employee to quarantine or stay away from the workplace for a period of time upon returning from that vacation or that large gathering. And it's good to let employees know that that evaluation will happen when they return, because they may then want to change their plans. And finally, other considerations involve what I'll call recalcitrant employees. Some employees we've encountered are either intentionally or unintentionally not complying with employer protocols in the workplace, be it social distancing, use of masks, regular hand washing. And so I would encourage you to train your managers on how to address those recalcitrant employees. I know John Geiringer will hopefully, if there's time, touch briefly on requiring customers to wear masks, but you definitely should be requiring your employees to wear masks and follow social distancing. So in the interest of time, I think I'll skip over a good part of the considerations on returning, the flip side of this, returning fewer employees to the workplace. But I just want to say that there are many experiences that were had during this shelter in place and having employees work from home that can help inform how you may do it differently if you're required to have fewer employees in the workplace in the future. I'll note that we've been working with clients who are completely rethinking their retail banking, their number of branches, the number of employees. And the pandemic has been called an accelerant for many decisions that organizations were considering, but were also not ready to implement. So this pandemic may have shown that you could truly work with fewer locations, operate with fewer employees. And so if you move to a smaller workplace, we certainly want to mitigate employment-related litigation in that context. So it's always the case that we have our non-discrimination rules that we have to be concerned with. But this moment requires us to be careful that we don't have any concerns around whether we've granted employees leaves that they're entitled to, such as under the Families First Coronavirus Response Act, that if we're getting releases because we're offering severance, that we've updated those for many state law changes that have occurred over the last year or two. If it's a significant change in the number of employees you have, do you have WARN Act obligations or state WARN Act obligations where you have to notify not only the employees well in advance of their termination, but local authorities? And then finally, workers' compensation is litigation that we're starting to see. I'll say that if you're following the protocols that the CDC and OSHA have provided for how to create a workplace where the transmission of the virus is less likely, then those claims will be more difficult to bring when you can show that. So with that, I hand it off to the Behringer report.
How much did you pay Lynne to change it around there, Mr. Geiringer? It's Behringer, but that's all right. We're about to do the fastest Behringer in the history of Behringer. So with that, I'm going to turn it over to my favorite John Geiringer.
Thanks so much, Mr. Behringer. And since you and I last saw each other, I gained a beard, but I lost half my face due to Bell's palsy. So just so you know, I have not started drinking yet, notwithstanding watching the news for the last few weeks. I just think we're going to have to update our logo, though, for the beard if you're going to keep it long term. So when we see all these fine people in person next time, it really matches the look. So with that said, take it away. Thank you. Well, what I thought we'd do is start from a very high level with the regulators, what we're seeing. And that is, for at least the next few months, we have leadership at the agencies with private sector experience. And the question is, what's going to happen in the next election? And there seems to be, among those agency leads, truly a sense of energy and urgency, whether you read their speeches or you listen to some of the rumor going on in Washington. There is this urgency to get things done under their agenda. So what I would encourage everyone to do is, to the extent that there are requests for notice and comment, Elena McWilliams, who heads up the FDIC, has said that they listen to individual banks, sometimes in a way that they don't listen to your trade associations. on important issues, because each one of you brings something unique to the table. So I would encourage you over the next few months, while you have these regulators that are relatively supportive of the banking industry, we never know what the next administration will bring, make sure you respond and make sure you provide them both formal and informal commentary around the questions that they're asking about how to redefine CRA, how to look at broker deposits, and a whole host of other issues that they're contemplating. The other thing I'd say is, unlike the last crisis, and most of us on this call are old enough to remember the last crisis, is that this pandemic has really brought empathy and flexibility in a way that I think that the last crisis didn't, because in effect, they are facing the exact same issues that banks are. Those regulators are working from home. Those regulators are dealing with shorter staff. So I think that has engendered some degree of empathy and flexibility on their parts. And you see that in things like allowing banks to extend call reporting period in the last quarter, which I never thought I'd see. We see other deregulatory efforts that they've been doing, and flexibility that they are allowing banks to do that I never thought was possible. The big question is, to what extent that trickles down. And with that, we'll turn to the next slide and see what we're seeing in the early examinations we're seeing during the COVID era. And what that really entails is these challenges with the offsite environment. And John, feel free to weigh in at any time. We're talking to our clients, and it's funny, for the last 20 years, I've heard them complain about how much they want to get the examiners outside the bank. Lately, all they're saying is, bring them back, because they miss the human contact. They miss being able to have those one-on-one conversations that you just miss when you go online. Just like here, we're missing the human conversation in this seminar. And so in a similar way, I think bankers really miss, to some extent, having examiners being able to talk to them, walk by the doorway, ask them, do you have any questions? Do you need any more information? And what that means is that there's going to be an increased importance of documentation, whether it be loan files, whether it be policies and procedures. John, you want to jump in?
Yeah, sorry, I was going to say, on the documentation, the biggest thing to think about there too is a lot of your operations went from inside the four walls of your building to off-site. So how does that change? How does the tenor of remote work change your risk assessment? Not only for financial reporting issues from a SOX or fiduciary standpoint, but just from pure operations, whether it's your compliance program, whether it's your BSA AML program, what are those things? And making sure you've gone through and updated your risk assessment to capture those things is really critical, and get your control owners on record as saying, hey, did anything change or did anything not change, so we can target our internal audit activity as well as our risk management activities to account for that. So John, sorry to cut you off, but I do think that's a real key takeaway with the bullet, on top of the usual, you can't document enough in the loan file, right? Particularly given the environment we're in, because you're not going to remember what you decided today 9 months from now. So go ahead.
That's right. And there's been a bunch of changes, presumably, to your policies and procedures and the way in which you did PPP and things like that. And I think from talking to the regulators, that they're going to be relatively accommodative towards those things, but they are going to want to see that documentation. And, you know, I would, whenever your next exam is, and presumably most of it's going to be virtual for the foreseeable future, you want to create that environment where you, even if it's virtually, knock on their doors, give them a call and say, here is, let's have a check-in every day or every week, and let's see if there's anything we can get you, anything you're missing. Those kind of things can go a long way to have a smoother exam. The other thing I'd say is read the exam guidance that came out very recently from all the regulators, which said along the lines of what they've been saying for the last few weeks, which is, on the one hand, work with your borrowers, on the other hand, safety and soundness. But the one nugget I took away from that guidance that I was a little surprised that they said was, especially with respect to the management rating, they're going to take into account what your bank looked like just before COVID. So in other words, if you had some large concentrations that COVID made worse, I think they're going to have less sympathy on you than if you had a more balanced portfolio, because they've been saying since the last crisis how you need to make sure you need to do a better job on things like concentrations. And to the extent you did not listen to that guidance, and that was your bank on, let's call it on January 15th before COVID hit, they are going to take that into account when they determine your management rating. By the same token, if you had a more balanced portfolio, if you had good stress testing and policies and procedures that only but for COVID threw out of whack, they're going to take that into account. Now, at the end of the day, I'm sure John let you weigh in here. You know, once you see credit issues, and I think we're going to talk about that in the next slide. Once you see those credit issues, then there's going to be less ability for the regulators and you to maneuver around, you know, having downgrades in your ratings.
I agree, John, and actually, in the interest of time, Michelle, if you can jump to the next slide, I would concur with Mr. Geiringer, though. Take a look at the FFIEC release on the COVID impact on exams. I thought it was great guidance. I think you pulled the nugget out of there, but I also think coming back to thinking about, and actually it's one more slide, my apologies here, on the credit piece, is, you know, we've been doing a lot of credit reviews that were already scheduled, and we're shifting timing and adding some more targeted reviews as we go forward. But I think what we're finding is we've got some banks that are reluctant to move, saying, well, it's a COVID issue. I get it, and I understand the frustration with that, but it's still creating a credit issue. And in some cases, depending on the borrower's industry, what could be a long-term credit issue. So I could have argued in 9 and 10, well, if it wasn't for this little real estate valuation thing, this would be a great development loan, right? And so I understand the frustration with that, but I think you've got to be realistic. A lot of those borrowers were on the precipice. The question was, what was going to be the event that tipped them over? Unfortunately for some, it was COVID. And so you're going to need to be realistic in assessing that and assigning those risk ratings. And you know, pointing to COVID and saying, well, it's going to be a quick bounce back, I think is we heard earlier, likely, you know, we've all along said it's likely to look more like a Nike swoosh type recovery than a V type recovery. And we're seeing that play out. And some industries are just going to be hit harder than others. And I think one of the other areas is consumer lending. And depending on what your consumer borrower looks like, you could potentially be getting hit pretty hard in that portfolio as well. So I think, unfortunately, you know, some concentrations more susceptible than others, and you're just going to kind of have to manage that. So, John, other thoughts on this? And sorry, I skipped your last slide, but just wanted to make sure.
We should tell the audience we are running a little late, but hopefully you can stay with us because hopefully this content will be helpful for you in the next few months. What I would say is for those of us who have the gray hair, who lived through the last crisis, and in our case, we saw about 20 banks fail, and we saw really, if we can go to the next slide, please, we'll come back to pandemic in a second. You know, there was a game plan for how banks can help to avoid falling into that trap. And I think, you know, it almost feels now a little bit like it did in the summer of '08, that you knew something was happening, but you didn't know when, and you didn't know how bad, but it's almost a calm before the storm. And what I would encourage banks to do in light of the lessons we learned from the last crisis, this is now time to make sure your board is re-engaged, that they are that credible challenge around the boardroom, that they look at updating stress testing. You know, any stress testing that was done before February is probably anachronistic by now. Having that fortress capital. I know Rob talked about 094 earlier, and I think there was an article this week in American Banker saying banks should not declare dividends. I don't agree with that, but per se, but that's the kind of messaging we're seeing out there in the industry. Making sure that you resolve troubled assets in advance, have that game plan. So for example, during the last crisis, some banks, what they did is they bought troubled assets out of the bank into their own holding company. Well, you can't really do that unless your holding company has lending authority, and it's not automatic. So you need to get prior Fed approval if you're not a financial holding company. And if you are, then it's an after the fact approval. But in any case, you need to be talking to the Fed if you want that authority. It's not automatic. So things like that you can do in advance. You know, just like Rob had mentioned earlier about getting that Kroll report in advance, you know, doing things either with your regulators or doing things in your policies and procedures, knowing that you may have this wave of industries that are hit hard once the PPP and once some of these other government programs run out. would serve you well. And John, before we take a step back to pandemic, anything else on this slide?
So I think it's really, you hit the nail on the head, John, just stress testing and really loan level stress testing too. We've seen the event now, and so now we need to kind of plan and work around that. So updating those strategies, dusting off the capital, even liquidity plans, and making sure they make sense in light of the current environment, and honestly changing depositor behavior in response to the crisis. All things you're going to need to think about as you look at those things.
Great. Last slide, please. I'm sure you've been pandemic to death, but I think we have a little bit more to talk about, which is that, this is different from a business continuity plan, which is your typical plan when you have an event such as a flood, such as cyber issue. This is different in scope, this is different in time, this is different in geography, and I think we need to be prepared for that next wave, especially when COVID interacts with flu season. And so I think what we want to have is better external coordination. And that means looking at what the trade associations are coming up with in terms of best practices for banks, staying closer in touch with your regulators, knowing who in the local community are in charge of medical and supplies and things like that, that you may need to get a hold of in a hurry. Because as we saw, a lot of us made fun of that pandemic planning guidance when it came out in 2006, and nobody's laughing anymore about that. And so this was the ultimate tabletop exercise for whether or not your pandemic planning worked. And I think now that there's a little bit of a calm here in Illinois, presumably before the next phase, I think now's the time to rethink issues such as remote access, both for employees and for customers. Lynn had mentioned earlier about employee protection. Customer protection becomes an issue as well. And we've seen some of our clients get questions about these rogue customers who insist that they do not want to wear a mask. And in situations like that, they've said, well, we're going to tell your regulator that you forced us to wear a mask. To which we say, guess what? The bank's regulators have said, we're going to defer to banks on what they want to do with respect to safety and security. And so make sure you have that handy. Make sure there is guidance from the interagency guidance from a couple of months ago. And if you can't get a hold of it, we'd be happy to share it with you. That basically says banks have some deference from the regulators in terms of what they want to do, and likely won't be second guessed. So your customers can run to the regulators all they want, but at the end of the day, you decide on your own safety and security. And then finally, I think it's important to take a step back and do that business impact analysis. See what you did right and what you did wrong over the last couple of months, and think about what you need to do better over the next couple of months, whether it be shoring up equipment, whether it be deciding, how you flow through employees in a way that's socially distanced. All of that this summer gives you a little bit of a window of opportunity before presumably things will get worse coming in the fall and the winter. 2 slides, please.
Yeah, and John, I was going to just off that real quick. One other thing to think about again is you raised it was the equipment issue. I can't tell you the number of banks I talked to that were scrambling to get enough laptops or desktops that employees could take home and continue to work with. And then what they took in some cases was stuff that was sitting in the storage area and nobody had looked at in a while. So it wasn't necessarily running the most updated version of Windows or patched or those kind of things. So taking the time right now to take a step back, make sure you've updated that. And quite honestly, how you patch in a on-site environment may not be appropriate in a remote environment where we know cyber risks have increased, exponentially because we got a lot of bad actors that know we've got a lot of folks working from home and many for the first time. So there's exposure there. So make sure you're working with your technology team and making sure you're truly evaluating if you're in the best position to support that telecommuting or remote work going forward.
Great. Now I know our time is short, so we'll shorten up the slide a little bit. The BSA AML issues we've been seeing mainly have been surrounding cannabis-related businesses. It is banks that have jumped in maybe too far, too fast, who haven't done the risk analysis, who haven't done the right training or policies and procedures. Those are the ones who seem to get in trouble, and we've even worked on a few enforcement actions along those lines. So I would encourage all of you, as more and more cannabis-related businesses crop up, no pun, here in Illinois, we're going to be seeing that you're going to be touching it more and more. So make sure from the outset you are making decisions around how far into cannabis you want to go. Is it just marijuana? Is it just hemp? Is it just lending? Is it deposits? Whatever posture you want to take, make sure that's well documented. Make sure you have in your account opening agreements, asking questions, are those marijuana related businesses? Make sure you're doing the board training to get you there so you can make informed decisions along those lines. We didn't see.
Well,
go ahead.
So I was just going to jump in and tying this to the triple P, because this has come up the last day or two in talking to some folks. You raise an interesting question with cannabis, which is, those loans, those companies should not have been eligible for triple P loans based on the fact of their business. But when you go in and you look at the number of loans that were granted, there were several cannabis companies on that list that got triple P loans. So the question would be, if you were applying your BSA AML program as you said you were, and presuming that borrower already worked with your bank in applying for that, how did you apply your high-risk BSA AML program to those borrowers? So I'd encourage you, if you were active in triple P, to make sure that you bounce those borrowers against your high-risk customer list, and you've got documentation of how you followed your BSA AML policy as it related to that, because I do think that's something that slips through the cracks.
Yeah, good point. On CRA and fair lending, what we see in connection with banks that have decided to close branches, I think Lynne had mentioned, or someone else had mentioned, the fact that what COVID did is really force issues that were going to happen eventually anyway. And we've seen a lot of banks evaluate what branches they're going to close. And in doing so, I always tell them to be mindful of, to the extent that they are closing branches in either lower moderate income areas or majority minority areas, that they're deciding what they're going to do to feel the breeze.
Oh, I'm going to be at United
Lending,
Terminal 1
investment,
towards the end.
services, and the like.
Sorry about this.
Because eventually they're
over.
going to be evaluated when the time comes, either on CRA or fair lending, what they've done when those branches close. So that is a big issue we're seeing, these days as banks, a number of them we've seen even the last few weeks, have decided to close branches. And I think we've run way out of time, so I think maybe we can go to see if there's any residual questions from the audience.
Yeah, thanks everyone. This is Rob. We did go a little long, but the good news is our numbers held up. So any other questions people have before they hang up? I will say I liked John Behringer saying that the recovery might be more like Nike Swoop, which would be better than the Under Armour logo. So let's go for the Nike Swoop. And Geiringer, I can't let you say again, we're getting pandemic to death. So that needs to get off your
Fair enough.
Any other questions or anything? Or closing observations from John or Brandon or anyone else?
No, I just want to say thank you again to all the attendees today. Feel free to reach out if you have any follow-up questions to any of the panelists here. And thank you to our colleagues here and friends at Barrick and Piper. Hopefully you found this as enjoyable as we all did and valuable. I'm sure we'll be talking to you again sooner than we realize. Probably still remote is my guess if I was betting.
Great. Well, thank you, everyone. Hope to be in touch through the upcoming weeks. Thank you.